Hello traders, and welcome back to the ComLucro channel. In today's chapter of our course, Technical Analysis for Day Traders, from Basics to Advanced, we're focusing on one of the core pillars of trading, market structure. Understanding market structure is key to gaining an edge in the markets. It's not just about spotting patterns. It's about reading the flow of price action, recognizing how trends form, and identifying the zones where high probability trades occur. At its core, market structure helps you align with the trend, anticipate shifts in momentum, and manage your positions with clarity and confidence. It's what separates reactive trading from strategic decision-making. In this video, we'll break down how to identify break of structure points, valid pullbacks, and trend reversals across multiple time frames, so you can refine your edge and improve your timing. Let's dive in and build a solid foundation for understanding how price truly moves. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Before we get into the details of price action or market structure, it's crucial to understand the importance of using multiple time frames in your technical analysis. To gain a clear view of the market, you should never base your decisions on just one time frame. By analyzing at least 2, or ideally 3, time frames, you can ensure that your market reading aligns with the overall trend and the smaller movements, which helps optimize your entry and exit points. Let's start by discussing why this approach is so important. The higher time frame, for example, the 60-minute chart, is used to define the main trend in the market. It provides a broader view and helps you identify whether the market is in an uptrend, downtrend, or consolidation. On the other hand, the lower time frame, like the 15-minute chart, is where you'll look for entry and exit opportunities. On the 15-minute chart, you're looking for confirmations and smaller moves that are in sync with the larger structure. So why is it essential to use 2 or more time frames? Doing so ensures that you're trading in line with the larger trend, reducing the risk of going against the market flow. Now that we've covered why using multiple time frames is essential, it's also important to understand that market movements are fractal in nature. But what does that mean? Essentially, the patterns and structures we see in the higher time frame, like the 60-minute chart, are often repeated on smaller time frames, such as the 15-minute chart. This repetition across different scales is what we refer to as fractals. Whether you're observing the market on a larger or smaller scale, the same principles of market structure, like higher highs, lower lows, pullbacks, and impulses, are evident. Fractals help us understand that the market operates in repeating cycles. This allows us to apply the same market structure concepts across all time frames. To bring more clarity to this concept, Al Brooks shares a practical insight on how setups are present in every chart, regardless of the time frame.
To me, if you take away the time frame and just look at any chart, they're all the same. And there are thousands of ways to construct a chart for what's taking place during the day. And it doesn't matter which chart you take, there will be plenty of setups on every chart. And I realized that by trading the 5-minute chart, I'm missing all kinds of other setups on the 1-minute chart, the 3-minute chart, volume charts, all kinds of other charts. And I don't worry about it. So you simply look at the chart that you have in front of you and don't worry about the hundreds of other setups that you're missing on all of those other time frames. Any one chart will have plenty of setups, and if you just focus on one chart, there'll be plenty of opportunities to make money.
This reinforces the idea that no matter the chart or time frame, patterns and opportunities repeat themselves. Your edge comes not from chasing every setup across time frames, but from mastering the one in front of you. Now, let's break down the key market structure concepts you should be watching across different time frames. In a market that's trending upwards, we see a series of higher highs and higher lows. But what does that mean exactly? Higher highs occur when each new peak is higher than the previous one. This indicates that the market is gaining strength, with buyers pushing prices up. Higher lows happen when the lows also get higher, which tells us that during pullbacks, the price is not dropping as much, and the uptrend is still intact. Now let's look at the opposite scenario. When the market is trending down, in a downtrend, we see lower highs and lower lows. Lower highs mean that each new peak is lower than the last, showing that sellers are in control. Similarly, when the price drops below previous lows, we see lower lows, which confirm that the downtrend is continuing. So, how do you apply this knowledge in real trading? The key to successful analysis is checking if the market structure is aligned across time frames. Here's how it works. On the 60-minute chart, if the market is forming higher highs and higher lows, it signals that the main trend is upward. When you check the 15-minute chart, you want to see confirmation that the market is also forming higher highs and higher lows. When both time frames show the same trend, you know the market is aligned. And this gives you greater confidence to place buy trades. However, if the 60-minute chart is showing an uptrend, but the 15-minute chart starts forming lower highs and lower lows, this misalignment could indicate a correction or even a potential reversal. And that's a signal to be cautious. You need to always remember to analyze the market across multiple time frames to ensure your reading aligns with the bigger picture. This increases your chances of making successful trades because you're moving with the dominant trend. Now, let's dive into pullbacks. A pullback is a temporary retracement in price before the market resumes its main direction, offering traders valuable insights into key movements, trend strength, potential breaks, and reversals. So, how do we recognize a valid pullback? A pullback is based on candlestick formations. In an uptrend, it's identified by a sequence of bullish candlesticks, each closing higher than the last, signaling sustained upward momentum. Additionally, the low of each candlestick stays at or above the previous one's low, showing that selling pressure is minimal and the bullish trend remains intact. Similarly, in a downtrend, we see a series of bearish candlesticks, each closing lower than the previous one, confirming a continued downward trend. The highs of these candlesticks remain at or below the previous one's high, indicating weak buying pressure and that the downtrend remains strong. Now, how do we pinpoint a valid pullback in a bullish market? A valid pullback occurs when a candle breaks below the previous candle's low, sweeping liquidity. For instance, when the fourth candle breaks the low of the third, it confirms a valid pullback. If the price doesn't break below, it's not considered valid. The color of the candle doesn't matter in identifying pullbacks. The same applies in a bearish market. A valid pullback happens when a candle breaks above the previous candle's high, sweeping liquidity. Let's dive into a few examples to clarify. Here, we see a bullish candlestick sequence followed by a series of bearish candles. This is our most recent high, which creates the latest low. However, this isn't a valid pullback because none of the candles break below the low, and this movement remains contained within the previous candle. There's no liquidity sweep, so we'll treat this as a single bullish move. The same applies in the second example. The market is bullish, but none of the candles have taken out the previous lows, meaning we don't have a valid pullback in this case either. Now, in the third example, notice how the bearish and bullish candles have equal highs. Here, if the price takes out the low of the bearish candle, that qualifies as a valid pullback. Remember, this concept applies to both bullish and bearish markets, and you can use it across any chart and time frame. Now, let's review some examples on a live chart. Here, we have the British pound against the Japanese yen on the 1-hour time frame. We'll start by identifying the pullbacks within the candlestick-based price action. Beginning on the left, we observe the most recent high and low. Since none of the subsequent candles break below this low, it's not a valid pullback, so we treat it as a single upward movement. For a pullback to be valid, the price needs to break below the candle that formed the latest high. Moving forward, we encounter a valid pullback. The low of this hammer candle, which marked the latest high, gets taken out by a bearish candle, confirming a valid pullback. Afterward, we see another deep pullback as the price breaks below the candle that set the latest high. Finally, the next pullback happens here with a doji candle that sweeps the lows of the previous candles. In a bearish market, for a pullback to be confirmed, the price must break above the high of the previous candle that formed the most recent low. Mastering this concept takes practice, as you'll encounter various scenarios that may look different on the chart. Now that we've covered pullbacks based on candlestick formations, let's shift our focus to understanding impulsive and corrective moves within the broader market structure. In an uptrend, an impulsive move is characterized by a strong bullish push, showing significant upward momentum. On the other hand, a correction represents a temporary retracement in the market, which pulls back from the main trend but doesn't necessarily indicate a reversal, often taking out a previous pullback before resuming the trend. A break of structure happens when the price breaks above a significant market level following a corrective move, forming a new higher low. This break confirms that the market is likely to continue in the bullish direction. Meanwhile, a change of character occurs when the price breaks below the lowest point of a corrective move, signaling a loss of momentum. This often serves as an early indicator that the uptrend is weakening, and we may be heading toward a trend reversal. Starting from the bottom, we see an impulsive move that includes multiple pullbacks based on candlestick formations. The next move is corrective, as it sweeps the liquidity beneath the most recent pullback. Once the market completes this corrective move, we identify the new level as a higher high or a market structure point. If the price breaks the structure to the upside, a new higher low will be established, indicating continued bullish momentum. After this, we observe additional impulsive and corrective moves that continue to break the market structure. These points, where corrections end or impulses begin, are key in determining the market's overall direction. As long as the price remains above these critical levels, the market is considered bullish. However, if the price breaks and closes below these levels, the uptrend is likely over, signaling a potential reversal. This is what we refer to as a change of character, marking a shift in market momentum. The same principles apply in a bearish scenario. Here we observe impulsive and corrective moves reflected in the candlestick formations. These moves serve as corrections within the overall market structure, as they sweep liquidity above minor structures, helping to define lower highs. A change of character occurs when the price breaks and closes above a significant level, signaling a potential shift in the trend and a loss of downward momentum. This break above key levels may indicate the market is preparing for a reversal or a shift away from the bearish trend. Here are a couple of key points. When liquidity is taken out, either below or above the pullbacks, it can happen through a wick or a full candle close. Both methods are considered valid. Whether it's a quick spike in price, a wick, or a confirmed close beyond the level, both scenarios signal that liquidity has been swept, which can indicate the next move in market structure. Understanding this helps traders anticipate potential reversals or continuations. To confirm a valid break of structure or a change of character, it's essential that the price not only breaks, but also closes above or below. In a bearish scenario, the key market structure level, a wick alone without a full candle close beyond the zone, is not considered valid. This ensures that the market has firmly committed to breaking the structure, reducing the likelihood of false signals and providing a more reliable indication of a trend shift or continuation. A corrective move that follows an impulsive move can include multiple pullbacks, but the key point to focus on is the lowest point of the correction, which is identified as the most recent swing low. This swing low acts as a critical level in the structure, and any break below it can indicate a potential shift in market direction or momentum. It serves as a reference point for determining whether the corrective phase is likely to end or continue. Now, let's dive into more examples. We are looking at the New Zealand dollar against the US dollar on the 1-minute time frame. Where do we find the valid impulse and correction? In this case, the market momentum is bullish. The price made a pullback and continued pushing higher. The next move qualifies as a correction, since it took out liquidity below the prior pullback. Once the market breaks this higher high to the upside, it confirms a valid break of structure, establishing this level as a valid higher low. Next, we need to locate the most recent liquidity and pullback. As discussed earlier, this small area of consolidation isn't a valid pullback because it hasn't broken the previous candle's low. Therefore, the most recent pullback lies here with liquidity positioned below it. If the market retraces deeply and sweeps the liquidity below this pullback before continuing upward, we'll have another valid break of structure. Let's see what the market does. As you can see, the market moved higher, But this isn't a valid break of structure under our rules for confirmation. The market needs to sweep the liquidity beneath the recent pullback. This remains our most recent pullback, and since it hasn't been mitigated, the entire move is still part of the internal structure. Consistently, this area is our most recent pullback, and liquidity resides below it. Should the market retrace deeply and trigger liquidity, it will be recognized as a corrective move and will confirm a valid break of structure if the price pushes higher afterward. Let's break down the market direction and movements. We're currently in a bullish market, with the latest pullback, impulse, and correction clearly identified. The price has made a valid break of structure, confirming this level as our most recent higher low. As long as the market holds above this level, we remain in an uptrend. Should the market retrace and sweep liquidity below the latest pullback, we'll see another corrective move. If the price resumes its upward push, we'll mark a new break of structure, impulse, and higher low. Now, let's see how the market reacts. As you can observe, the market broke and closed below the higher low, confirming a valid change of character. With this shift on the chart, market sentiment turns bearish, signaling an expected trend reversal. The movement that triggered this change of character now becomes the start of a new impulsive wave to the downside. This is where we once again apply market structure concepts. We begin identifying pullbacks and looking for liquidity sweeps to confirm corrective moves. Here's our most recent pullback based on candlestick formations. So let's monitor what the market does next. In this case, the price took out liquidity above the pullback, confirming a correction and marking this point as a new structure level. Following that, the market broke structure to the downside, confirming this level as a valid lower high. We will continue applying the same smart money concepts to market structure, identifying pullbacks, impulses, corrections, trend directions, breaks, and reversals. These concepts can be used on any pair or time frame, though mastering them requires time. So if your strategy relies on trend continuation, use these techniques when you can clearly define market direction using the methods we've discussed. Now, let's move on to the next topic, analyzing market structure across multiple time frames. By examining structure through multiple time frames, we gain a more complete understanding of market conditions, allowing us to identify key levels, trends, and patterns that might not be visible on a single time frame. This multi-time frame approach helps traders make more informed decisions, reduce risk, and increase their potential for profitable trades. So, how do we effectively analyze structure across different time frames? Here are a few essential tips to guide you. In our trading strategy, we use two types of time frames, the higher time frame and the lower time frame. The higher time frame is used to assess the overall market direction, key levels, and the broader picture. Meanwhile, the lower time frame is where we conduct most of our detailed analysis, examining market direction, supply and demand zones, liquidity areas, chart patterns, and potential trade setups. Once you've applied the market structure concepts, it's crucial to ensure that the structures align across these time frames. Look for confluence between the higher and lower time frames. When both charts are in agreement, it strengthens the validity of your analysis and significantly improves your chances of executing successful trades. To reinforce this idea, here's a practical reflection from Phil Goedeker on how focusing only on high probability setups and being selective with your trades can dramatically improve results.
Now, how many of us here of traders have followed a chat room, a Twitter, or a friend into an idea that we knew was not a high probability setup for our own trading style? Now, we all have different trading styles here. What works for you may not work for me. Personally, I'm a terrible long bias trader. If and when I ever do go long, I take profits extremely fast, knowing that a lot of times profits can just get away from me pretty quick. I don't have the patience nor the conviction, to hold them. That's why month after month, year after year, I personally get more strict about the trades that I place. I probably place half the amount of trades I did maybe just 5 years ago, but I make way more money. Why? Because I trade the high probability setups that I know I'm going to be profitable 80 to 90% of the time. I like to use size with those trades, and I have very strict rules when it comes to cutting losses.
Now let's take a look at a real chart example. Here we have the euro against the US dollar on the 4-hour chart, which we're using as our higher time frame. Later on, we'll zoom into the 1-hour chart to analyze more details and align our confluence factors. Here, we clearly see a downtrend. So let's break down the most recent impulse, correction, and pullback. This is our latest pullback because it swept liquidity above the previous candle that created the recent high. The move following this pullback is our correction, as it also swept liquidity above the pullback level. As long as the price stays below this level, we consider the market bearish. Now, let's observe how the market reacts. Once the price breaks and closes above the latest lower high, market sentiment shifts to bullish. Our higher time frame indicates that after a prolonged downtrend, the market may be reversing. Let's now zoom into the 1-hour chart for a closer look and to identify further details. On the 1-hour chart, we can observe that the change of character signal appeared much earlier. This is our most recent correction, which resulted in a break of structure and established our latest lower high. Following this, the market failed to create a lower low, eventually leading to the change of character. At this point, both the 1-hour and 4-hour charts suggest a potential reversal, presenting us with opportunities to consider buying. Utilizing multiple time frames offers several advantages. It provides a broader market perspective, allows for trend confirmation, helps in pinpointing optimal entry and exit points, and strengthens risk management strategies. By factoring in different time intervals, you can make more informed and precise trading decisions, improving your overall strategy. In conclusion, understanding and mastering market structure is one of the most critical skills a trader can develop. By analyzing higher highs, lower lows, pullbacks, and breaks of structure across multiple time frames, you're able to gain a deeper insight into the market's overall direction and spot high probability trade setups. Remember, aligning the larger trends with smaller movements allows you to trade with more confidence, reduce risk, and ultimately improve your performance. Always be mindful of the importance of patience and discipline, as trading isn't just about identifying patterns, it's about applying your knowledge consistently and staying emotionally disciplined throughout. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology, because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.